You're listening to QSBS Solved, where we share insights for founders and investors looking to maximize their business's growth, exit opportunities, and tax savings. Our team at QSBSrollover.com offers specialized services to help you benefit from owning qualified small business stock. Our podcast guests are leaders in their respective fields and work on every side of the startup journey to help founders and investors win. The ideas and opinions shared here are not investment, tax, or legal advice. Reach out and we'd be happy to connect you with a qualified advisor or tax counsel. For now, enjoy today's episode. Hey everyone, welcome back to another episode of QSBS Solved. I'm joined by attorney Scott Dolson, partner at Frost, Brown & Todd. Scott is prolific in the QSBS world, does a ton of writing, probably the most amount of writing done, call it on the academic side of QSBS, publishing his blogs. I actually put together a compilation of all of his articles, and in some I had them bound together, and it was about 600 pages. Scott, I have to send you a copy, but thanks for joining today.
Yeah, I think 7 or 8 years ago, one of my partners said, why don't you write a book about QSBS? And I said, well, I mean, nobody reads the books anymore, so I'll stay away from the book and just write a few articles kind of when something piques my interest and I'm doing work in it, that tends to trigger an article,
Yeah, well, before you end your career and retire, I'll have to send you the book. You can sign it, and who knows how much it'll be worth. It'll pay for your beach house. And
so you'll sell it on eBay for $9.95 or something.
No, but it's great to have you. I think, we talked, and something we want to focus on today is based off of a 2-part article, I believe, that you wrote this summer, which was about substantiating QSBS. And as we talked about that just before we got on, we were sort of both discussing how much more expansive the opportunity under QSBS is, I think, than most people realize. And so we want to both talk about how broad the scope of QSBS is, but also how people can substantiate, defend, and document their QSBS position when they have it.
Yeah, I mean, I think, from a planning standpoint, I mean, we do a lot of different, we do a lot of planning, we do a lot of structuring of roll-ups, working with M&A, transactions. So, I mean, I feel really good a lot of times about the planning. The whole gist of this article, though, is that are you going to be prepared to substantiate your eligibility when you take a return position, which is sort of two separate things because, there's that one case that is a real eye opener. It's like the Ju v. United States where, somebody had the $50 million test, which is one of the eligibility requirements, was the issue in that case. And they had information, if I have my numbers right, for 2009, the aggregate gross assets were like 2.15 million. So that's a lot lower than 50 million, right? But they lost because the court said, and so the IRS pushed this and the court agreed. They said, okay, it was 2 million in 2009, but the year we're talking about is 2003 and 2004, and you didn't provide us any information on that year. And, so the taxpayer, of course, says, well, if it's 2 million 6 years later, how could it be more than 50 million in 2003? Yeah. And the court said, well, I mean, essentially you have the burden of proof and you haven't substantiated that the company was under 50 million in 2003 when you were issued your stock. So, I mean, that's just an eye opener that, you need to have all the documentation, the proof that you've met these eligibility requirements. I mean, not everybody's going to get audited. Not everybody's going to be in tax court. Not everybody's going to have the same tax court judge or that's going to be as picky maybe as they might have been in that case, but you've got to be prepared for it if they are. And that's the whole concept of being prepared to substantiate your return position. And, that that's the focus of the article. And, I think the whole thing, the genesis of all of this was me having lunch with one of our tax litigators and just, kind of quizzing him during lunch. I should have paid for his lunch, quizzing him during lunch about kind of what are the elements that it would take to actually prove one of these eligibility requirements, and hearing it and saying, oh, wow, we really need to kind of get the word out and kind of really increase our focus on making sure that we've identified, all the elements it takes to prove a particular eligibility requirement, like the $50 million test. What are all the things that go into that? And then thinking through systematically, what information do I need to pull together where I can feel comfortable that I will win on that issue? I mean, it's sort of a two-pronged thing. One, what do I need to do to be prepared to essentially sit across the table from an IRS agent and convince that IRS agent, we're not low-hanging fruit, go away,
Yeah.
we're okay. And the other one is in tax court, what evidence, and having that evidence put together, and remembering, I won't keep going on, but the thing about 1202 is there's just these extremely long timelines. I mean, we might be talking about something that occurred 20 years earlier, and we've got to be prepared to substantiate that and for the whole 20 years in between, which is a burden that you don't always have on a particular return position.
Yeah, I think that speaks to the need for especially startups or, especially businesses that are raising capital, get large influxes of capital to their balance sheet at different times to make sure they have professional accounting in place when they are getting to that scale, because they may be missing, say, 4 years of records or 3 years of records at the onset, which is not a position you want to be in. The other is that it does introduce what you're talking about, introduces a ton of complexity for non-founding holders or non-executive holders of QSBS. Think about maybe like the 30th hire on the design team of a startup. If they hold their stock for 15 years, 10 years, they come back, how are they going to have access to any of the documentation that, of their company's accounting or financials or whatever else? Just talk about the 50 million asset test. Functionally impossible for them to substantiate that at that point. And so I'm kind of curious about what you think about these different actors, these different shareholders, and their access to information, what that means.
Well, I mean, it can be a really big challenge for some people. I mean, we have people that come to us and say, please do a tax opinion for me or tell me if I'm okay. And it turns out they're a fired early stage employee, or they're a founder that's been kind of shuffled out and have and didn't keep good records, doesn't have access now, is sort of on the outs. That's a very difficult situation to deal with. So, as a practical matter, sometimes it's difficult. Now, I mean, if they read the article I wrote, at least, if they're lucky enough to have read it, they can maybe try to get that information kind of out of the gate. Ask the company for, ask for a certificate, get some documentation. I mean, copies of the corporate tax returns are really a good thing. So some of those people, it's going to be very hard to help. With founders, knowing what they need, they could maybe get a hold of it if they really understood it. And, having somebody, an accountant, a lawyer, other professionals in the loop to help them understand what's needed and pull the information together is critical. And so there's that category of people, but there's also the more sophisticated kind of category, I guess, the family offices, the
angel investors outside the company.
People that have some leverage to get certificates that systematically go through and say, tell me about these 10 things and don't do these things, once I bought my stock, and you're going to help me when I need help. getting the information together, 5 years from now or 7 years from now. So, that kind of person, probably has, if they understand what they need to do, probably has the capability of getting that information together. And, like there's other, I mean, we haven't talked about it yet, but all these things about, tax opinions and other things. I mean, I'm working on one deal right now where a family office is going to put about 25 million into a deal, and they internally won't do it unless they have a more likely than not opinion on the 1202.
Mm-hmm.
And I mean, we typically do substantial authority opinions because that's the standard for a return position. But this particular family office just has their own internal requirements. So, they're getting kind of homework done kind of out of the gate by getting that. And there's one kind of touchy structural thing that they particularly are focused on. So they're obviously, they have their eye on the ball out of the gate on it,
Yeah, I mean, professional investors, sophisticated investors may have their eye on that, and the people that we work with most are founders of these companies. And unless you're a second or third time founder and already been, quote unquote, burned by not being able to claim QSBS, it's honestly very rare that a founder has their eye on the ball, as you say, that early on. Aside from, the normal get your ducks in a row kind of thing, which we've talked about in other episodes, what advice would you give a founder of a company starting out, maybe before they've raised a substantial amount of money, to make sure that 10 years down the line, their house is in order?
Well, I think you would, you need to be either somewhat of a student of 1202, or you need to work with somebody like you guys that understands the requirements and can help, pull there's the pull the documentation together.
Mm-hmm.
There's the don't screw it up, in other words,
Sure, yeah.
don't have a footfall along the way, so that, if 7 or 8 years down the road, you and all your investors, you're selling the company for a lot of money and there's a lot of 1202 gain exclusion available, you've got to have the documentation, and you got to not have made a mistake along the way. I mean, fortunately, we don't have this stuff happen too often, but, my partner in Nashville right now is dealing with an early redemption in a deal where it looks like that redemption has just killed the original issuance that found the equity,
Yeah.
and that's just a lack of knowledge of the rules. And you just got to have enough understanding of the rules, and no, you got to have enough understanding to be able to know even to call up your.
Well, that's right. Yeah.
And
most people in these deals aren't working with a tax attorney on their deal structuring that even understands QSBS. I think the call to our listeners who aren't tax attorneys or aren't CPAs or don't work with QSBS often is just to at least know when that yellow light kind of comes on and you say, hold up, we need to ping someone to just check on this, because I know that there's something with redemptions or stock buybacks, this kind of thing.
Well, we try to get the word out with all the articles, but it is hard. I mean, 1202 is a kind of a crazy favorable provision, but it has a lot of potential traps.
Right. And I mean, for us, you mentioned sort of the documentation, pulling all of that together. A lot of times at the point where our team comes in is obviously we focus on rollovers, is after maybe they've been in that business for, it could be many, many years. And we have no real ability to conjure up documents that maybe don't exist at that point. And so sometimes folks come to us and they say, well, I guess my original stock is QSBS, and certainly on the surface it looks like it, but they're very often in a position where they're scrambling at the end of their deal to try and pull together documents that they should have had together years earlier.
Well, I'll say better to scramble when they're dealing with you on the rollover than to scramble when they're selling the stock they rolled over into.
Well, yeah, that's true too. Yeah, I mean, really, we exist to help people maximize QSBS, but also to help people take care of QSBS in the right way, because we were seeing a lot of people taking extremely risky positions, especially with rollovers, like rolling money over into a corporation, then sitting on a beach in Cabo. That's not, so yeah, I think there's a duality there to what we try and help folks with. But let's talk about some of these. You mentioned that QSBS can certainly be expansive, and it's broader than people imagine. There have been just a few public or private letter rulings that we have access to where we can actually see some of their thoughts on active trader business or some of these other requirements. What are your thoughts on what we have seen from the IRS in terms of additional commentary on some of these touchy issues with 1202?
Yeah, well, there's sort of two strains of it. I mean, one, the private letter rulings are pretty consistent with the concept that if you're providing products and services to a category that's excluded, like healthcare, that you're okay. But if you're actually yourself engaged in the professional activity, if that's what your employees are doing, your employee is a physician providing physician services, then that's an excluded activity. But if you're somebody that looks at, kind of a third party radiology slide viewer company or something, you're okay. Or if you're providing the telemedicine platform, or if you're creating the drugs that are used in the healthcare industry, you're okay. There's that group of the private letter rulings, and those private letter rulings are for the most part consistent with the 199A regulations. Those regs are explicitly not authority for 1202, but all the private letter rulings are pretty consistent with the 199A regs that essentially say the same thing. So there's that group of the private letter rulings. There's a kind of I would say there's sort of two outliers out there. There's the favorable insurance broker one, where, if you kind of read it from a 50,000 foot level, it's sort of the conclusion is, well, we're not going to say you're an insurance broker because we look at what you do and you only spend a small part of your time actually brokering insurance, and the rest of the time you're scheduling your golf game or something or another, other activities, administrative.
Yeah, you're maintaining an account. You're doing, like sort of supplemental work to make sure that folks get the most use out of your platform or services or the insurance. Yeah.
So if I was trying to be negative in the IRS, I might have said, well, all of that is ancillary to doing the broker aspect. That's where you're making your money. But the IRS instead was very favorable and said, well, the time your employee is actually engaged in the broker thing itself was a small part of all the things that you are doing. So we're going to say you're okay. And then not that long after that, a chief counsel internal memo came out, and it was I guess you could get online and figure out which company it was. They don't tell you, but it was a platform that helped connect people that needed commercial office space, let's say in Denver, with somebody who has commercial office space in Denver, and they took a fee out of the deal. And so they technically were a broker, and they filed, I think, a 6045 form showing the broker fees, that they were involved in broker activities. And, this person at the chief counsel office was pretty negative, and she hung her hat on the fact that they filed this form. So I guess you could say, well, if you don't file that form, then maybe you're okay. But the upshot of that memo seemed to be a reaction against that favorable insurance broker private letter ruling. But I'll say that the private letter ruling is actually a tax authority for purposes of, taking a return position. I'm not sure whether that internal chief counsel memo is or isn't off the top of my head. But I certainly, when I write up opinion letters, I take both into account. But, I think the insurance broker one just gives you hope that you can make an argument. Plus, you got to remember, you always have the 80-20 argument that if 20% of your activity is an excluded activity and you have 80% that is not excluded, you're okay. So there's a couple levels of when we look at this to try to analyze and work our way through to reach the conclusion that you've met the 80% test, which is what this is all about, that 80% of your assets by value are used in activities that are not disqualified activities.
One way that I frame this up to some of our clients when they ask about, okay, well, how does that 80-20 work and stuff? Like the clearest example of something that I think they're trying to mitigate against is, for instance, like the company has an office building on their balance sheet and it's like 80% of their assets, or, a large amount of their assets, right? And they're just like McDonald's. I don't know, not McDonald's, but somewhere where you're basically a real estate holding company by virtue of your assets, but your real business is not that at all.
Oh,
so I think of that as an example, but I think there's a lot of fudging that happens with the 80-20 because most businesses aren't actively deploying all of their assets into like startups that raise money. Say they raise a $20 million Series A, they're probably going to be sitting on that cash for a substantial amount of time, and they're just not going to fail, quote unquote, that 80-20 rule, I don't believe.
Well, we've got so there's a couple elements in there, the working capital test, and whether something is working capital or investment assets that are going to be used within 2 years as working capital. Yep. So we have that to deal with. And then we also have the provision in there that if you have real property, and generally real property is a bad thing for 1202 purposes, but if you have real property that you're using in a qualified activity, you're okay. So, Amazon could, can own all the warehouses it wants to. I mean, obviously they're too big to be issuing 1202 stock, but conceptually they could do that. Yep. I mean, I run into ones that are, a little bit more aggressive, like, hey, I need to roll money over and I'm rolling over $5 million and I'll buy an old building in Louisville and I'll make the building and I'll put a little boutique grocery store on the first floor of the building, and this should work. That's the question,
Yeah. And I think that's what I was speaking to, right? Is like, well, actually all your value is in that building. So, you're real estate.
It's one of those things where, it hasn't been, it's going to be very fact oriented, but we don't have a go by in terms of a tax authority where it's been addressed in the 1202 context. So we live in the gray area, where we have to make judgments and just, realize there's a certain risk spectrum in terms of what we're doing. And you're very familiar with the 1045 rollover issues because you work in that area, and obviously people would like to do real estate because they don't really, they make a bunch of money on a real, venture startup. And then they get $15 million and they don't necessarily want to lose it, Yeah,
and they want to turn it into cash flow maybe too, which is, real estate becomes interesting in that way. One that comes up a lot for us is maybe like folks will call us and wonder, hey, I see consulting is an excluded category, and we typically refer to ourselves as a consulting business. And when they get to talking, it turns out they sell software, and they think of themselves as consultants because a client comes to them, they build custom software, ship it to the client, and then help maintain it over time, like, through their account. And to me, that's not consulting, that's selling software and maintaining software, simply solving a niche issue for a client and maintaining that relationship and the maintenance of the product over time isn't, to me, consulting. But that's a question that comes up very often when folks reach out to us.
Well, I'm just a lawyer who sits here doing this stuff, but from my observation, the concept of being a consultant apparently is a popular one, because that does happen a lot, where you look at the website of the person who you're working with and they talk about all the consulting that they do with their client. And then you look at the contract, and I had this with somebody that was doing, they go into banks and they look at the bank's requirements to meet regulatory requirements for money laundering software. And, the whole contract and the description was consulting. But if you actually looked at what they did, it's exactly what you just said. They actually write the software then, and they're really selling a product. They're selling the software. They're not really consulting. A consultant would tell them what kind of software they need, and then they go get it somewhere else, right? Tell me what we need. Here's what you need. We're done. Give us our fee.
That's a good distinction of, like, a consultant tells you what to do and then you go off and do it.
Right.
Because every business involves consulting with your clients, and most of the time you're explaining to them how to maximize the product that you just sold to them longer than you actually were spent selling them the product itself.
I mean, I've used the dumb analogy of saying, the guy who works at the Ford dealership consults with you about what
Sure.
car you want,
But then he goes to Chevy and buys it.
Yeah. Yeah.
No, that's a good way to think about it. We see that a lot in, like, defense contractors. I'm over here on the East Coast. I know you're not super far from me in Louisville, but a ton of defense contractors in Northern Virginia and Maryland, obviously, and they build all kinds of bespoke products, and many of them think of themselves as consultants because they came out of some agency and that's what they see themselves doing, but that's not actually really the work they're doing. In our remaining time here, about 5 or so minutes left, talk to me a little bit about the folks that you've been seeing come in your door since maybe the early summer when we started to think more about these changes. Have you seen clients thinking about QSBS in different ways now that it's been expanded a bit more as of July 5th? I know we did a webinar together on it. And the time period with which you have to hold your stock has been a tiered structure has been created where you have 3 years, 4 years, and 5 years of benefit available. Have you seen folks asking different questions, preparing earlier?
Yeah.
What's your
There's awareness of it for sure. And some people are, focused on how they can bring themselves within the new rules and whether there's any way to one, is there a way to transform their existing stock into stock that qualifies under the new rules? And I have to tell them pretty much there really isn't a way to turn the coal into gold. I mean, you can, like I was telling somebody yesterday, I mean, we can recapitalize your corporation, change some of your common into preferred, so it sort of frees the value. So if it's worth 10 million today, that 10 million is going to be under the old rules. But then if your company has a business purpose for needing more money, we can probably issue more stock, and that stock would be new, post July 4th stock.
Sure. Yeah.
So we do a lot of that. There's a lot of this kind of conversation going on. I think in general, you would have to think, since one of the things you and I deal with is, 1045 is a tool to deal with a problem, which is, we don't have the 5-year holding period. We have the 1045, we have the stock for stock exchanges, and now we have another one, which is, hey, we can get a partial gain exclusion after 3 years. So it definitely provides an incentive for, if you're doing choice of entity planning, then picking the C corporation, for the timeline thing is helpful.
Yeah, it seems like there are very few benefits for companies that have an inkling to sell during their lifetime or during the founder's lifetime, just say, to choose any entity structure outside of a C corp now with the lowered rates and some of these types of benefits.
Yeah, I think choice of entity now is it's a little bit of process of elimination. do you need to eliminate the C Corp for one of any number of reasons?
Sure.
And if none of those apply, then you got to ask yourself, is there a reason not to go with the C Corp here? And there may be, but I mean, I think you've got to do that. I mean, I've got a choice of entity presentation tomorrow morning. And I think it is that process of, are you going to be eligible under 1202? Can you find a buyer for stock? You kind of go through these things. And if the answer is yes on all of those, then we got to figure, well, is there really any reason to pick the pass-through versus the C Corp, given this monstrous, I don't know what you want to say about it. I don't want to be quoted by the IRS, but large benefit, it's there in the statutorily approved benefit, that's out there.
Yeah. Well, let's say not large enough, because I remember in our panel that we did our discussion about the changes under OBBBA, they increased, for instance, the gross asset limit from 50 to 75 million. But if they're actually trying to bring it up to speed with today's, with inflation, since when that number was enacted, it should be, what was it, 111 million or something? So yeah. So yes, it's a huge benefit, but maybe still not big enough. And we hope that more people will have the foresight to be able to take advantage of it. And ultimately for us, I think we see QSBS as doing really valuable work in keeping money in the hands of innovators, founders, folks who are moving the ball forward in terms of especially American technological innovation. So, my the libertarian position I take is I'd rather have that money in the hands of innovators and founders than, some other government allocators at times. But that's my libertarian stance.
Well, it's $50 billion probably better spent than a lot of $50 billion that the government spends.
I'm just looking at the roads out, around my house. That's all. That's my only frame of reference for efficiency of spending. But yeah, Scott, exactly. Thanks a lot for coming on and talking through these things. I don't want to. I want to emphasize as much as I can the value of the resources that you have on your site and your blog. You go to Frost Brown Todd and search QSBS. Anything you read will be either from Scott or maybe his partner Brian. But all that work is great, has informed a lot of the way that we think about QSBS. And hopefully we can continue working together for a while.
Sounds good. All right.
Thanks, Scott.
Okay.
Thanks for listening to this episode of QSBS Solved. We hope to hear from you soon. Remember that the content shared on QSBS Solved is for informational purposes only and should not be construed as legal, tax, or investment advice. While we discuss strategies related to qualified small business stock, or QSBS, including rollover planning, listeners should consult their own tax, legal, and financial advisors before making any decisions. Laws and interpretations can change. Individual circumstances do vary.